man, it's time to do another Q&A video.
Hey everyone, Ryan Bolton here, local mortgage expert, ryanbolton.com. I do mortgage lending throughout the state of Utah and Nevada, and I really like doing these Q&A videos. I just think they're a lot of fun to think off the cuff and just try to see where these questions are going. So let's just jump right in. I try to keep these to about 20 minutes or so. So let's see how many we can get to. The first question I have here is, when should you break your mortgage for a better rate? So this is basically talking about when should you refinance. So the idea has always been a 1% difference, but I have found that as the balances on loans have gone up, this number has changed. So for me, it comes down to when is the break-even point? If you have your certain amount of expenses or cost to get the loan versus what it saves you, where's the break-even point? If it's 15 years, it may not be worth refining. If it's 3 years and you're going to keep the home longer than that, that's when it starts to make sense to do a refinance. There's also the interest rate, also mortgage insurance. So I've actually seen times where the rate doesn't change that much, but by getting rid of mortgage insurance, the payment actually changes, the term can change, or it just frees up the budget to where you can pay off other things. So when it makes sense is really, where is that break-even point? How long are you planning on keeping the home? That really indicates whether or not you should save. It isn't just a magical, okay, I need to save 1% on my loan or 0.625% of my loan. It really just comes down to how long you're planning on keeping it. When is the break-even point? So that's how I'd answer that question. All right, let's see what else we got here. Let's go to the mortgage section. Let's see. Is it possible to get a home loan from a non-home branch? I don't know what that means. Can you refinance your home mortgage loan more than once? Absolutely. Yes. So there is no limit on how many times you can refinance. It just comes down to the additional cost and if you've recouped the investment to do it. But there isn't a restriction on how many times you can refinance as long as it makes a benefit. I will tell you this, though. Most lenders have what's called a recapture fee. So if you have not kept that loan at least 6 payments, then the originator or the person that did the loan has to pay back the fees that were generated because the loan wasn't kept long enough. So usually they have a 6-month clause to where they have to buy back the loan or buy back the fees, that type of thing. So usually you don't refinance that quickly, but it is something where there isn't a restriction on how many times you refinance, other than if you're going to do it before that 6-month mark, maybe reach back out to the same lender that did your loan and just let them know that you're possibly looking at another refinance. But very rarely do you see refinance that quickly, but we have seen rates dip a little bit. People just bought homes. Maybe they're trying to take advantage of a little bit lower rate. But there is, to answer the question, there isn't a restriction on how many times you can refinance your home. Let's see. How do you qualify for an FHA loan when buying your first home as a single female with no credit history? FHA loans do not necessarily require a credit score. Most investors do, but it depends on why the credit score is the way it is. If it's no history, you can still get the loan. But if it's bad history, if there's an actual score and there's collections and charge-offs and lates and stuff like that, that's when you'll run into a bigger issue getting the loan. But if you have lack of credit, that's what FHA will do. They don't really have a minimum credit score requirement, other than investors want to see a minimum score. It's just why is the score the way it is. So what they'll typically want to do is build some non-traditional credit, maybe Visa, or not Visa payments, but maybe like cell phone or Netflix or insurance or utilities or some other type of history that offsets why there's not a credit score. But the short answer is you can easily buy a home with no credit score unless it's a 0 score because of bad credit. Then you have to get those things cleaned up, get some positive trade lines, and get your score built up. So you can qualify. Even if you're a single female, single man, that part doesn't really matter. You don't have to be married to buy a home loan. In fact, we can't even discriminate against gender or age or marital status or religious group. None of those things, all those are protected with equal housing opportunity and fair housing acts and stuff like that. But there's still credit score requirements or credit history requirements. So it just depends on what's on the credit score. If it's a negative because of negative, or just lack of, just 0 because there is no credit. So we can still help you. Let's see. How come some people's mortgages are so low? Well, they just owe as much. I mean, that's usually a bigger indicator, or their lower rate, but it just don't owe as much on the house. So that's an interesting question. Okay, what else we got here? What are some ways of paying off a mortgage faster without increasing payments? There is no way. The debt is a certain amount of debt. If you don't pay extra, you're not going to pay the loan off any sooner. But here's something I would say about mortgages. You want to have other debts paid off first. I'm a big believer in Dave Ramsey. I'm actually trying to be a financial coach with their system. I'm going to add that to kind of my ability to offer products and services and be able to do some budgeting help for people, because I see how they just mismanage their budget. They don't track it. They don't know what's going on. It's kind of a scary thing sometimes. Or people just mess up and just quit. They just don't even do a budget anymore. But one of the things I really like about the system is you first want to have a savings. You want to have $1,000 emergency fund savings account first. I saw a stat that showed like 76% of people cannot have $1,000 expense without going into debt or having to borrow or something like that. So if there's a problem with the car or a health issue or something pops up, it basically puts them on the verge of having to either borrow more debt. If they can't borrow debt, they're basically on the verge of some sort of bankruptcy for $1,000. So first thing, build up that savings. Second, pay off all the other debts. So you want to pay off a mortgage faster, sure, but the amount of the payment to the balance is helping your cash flow, where you can build up your savings first, pay off everything else, and then take what you've been paying to other debts and plunk that on a mortgage. Then you can really start accelerating the balance of what you actually owe. But if you're trying to pay off a mortgage faster, but you still have other debts, other interest rates, or don't have your savings set up, I think it's kind of a cart before the horse kind of thing. Let's work on some other things first before we start tackling the mortgage. But this question is, how do you pay off a loan faster without increasing payments? There's no loan that can be paid off faster without paying extra to it. But free up the budget so the extra is just what you're redirecting. You're not coming up with new money. You're just redirecting that might be going to some other debt. So that's what I'd recommend, is finding ways to pay off other things quicker so you can free up the money to put it towards the mortgage. Let's see. Do you have to tell your mortgage company if you lose your job? No, but you may want to try to see if there's a preemptive forbearance plan you can do before you start missing payments. Sometimes I'll let you skip maybe a payment or two. During the holidays, sometimes you'll see them where they'll allow you to skip a payment. Just depends on the lender, depends on who's servicing it. But no, if you lose your job, you don't have to tell the lender what you did. Just like you don't have to tell them if you got a raise, or told them that you're increase your income, or switching jobs or something like that. So there's anything where you have to tell the mortgage company that you lost your job. Now, if you start missing payments, that's where it becomes an issue, where you may have to work with the lender on subordinating some of the payment or go into some other forbearance plan. But it is something where, no, you don't have to tell the lender that you've lost your job, switched jobs, got to pay, increase, decrease, whatever it is. Let's see. What is an installment? What is an installment in a home loan, and how many installments are there in home loans now? What is an installment in a home loan? I don't know if those are the two same things. Installment loans are typically just another name for a loan that you just have a certain number of payments that you make until the loan's paid off. So it's not the right terminology. Okay. Let's see. Can a bank foreclose on my house if I am current on my mortgage payment? No. Now, they can, other things can foreclose on your home, even if you're current. So if there's HOA or property taxes or certain things like that aren't paid, then they can foreclose on it for non-payment. But the bank cannot foreclose on a home if you're current on the mortgage. Now, they can foreclose if there's been misrepresentation, if there's been fraud, if there's been something where there's a violation outside of making payments. But to just answer the question as short as possible, if you're current on your mortgage, no, the mortgage company is not going to foreclose on it. Let's see. What are some good reasons to avoid taking out a reverse mortgage on your home? So a reverse mortgage, just like any other loan, has benefits or disadvantages. With a reverse mortgage, the balance is going up. The fees are a lot higher because they're building everything into that loan up front, even though they're not going to receive the full payoff on the loan for years and years, because the balance is just accruing. The fees are all added to the loan. So it's a very expensive loan. It's one of the more expensive loans out there as far as what's added to the balance. Nothing really comes out of pockets unless you're doing a purchase. If you're doing a purchase, you have a down payment, but there's really not, the fees and all that stuff aren't really getting paid back until the loan is sold, or until you sell the property or pass away and the kids sell the property or refinance it or something like that. So there's a lot of fees. The mortgage insurance, everything's kind of built into the loan. So it is a more expensive loan. It's also an adjustable rate mortgage. Most people don't realize that because they're not worrying about making a payment. They really kind of don't care in a sense, but you want to be mindful of what the interest rate can be and how much of it's added to the balance, that type of thing. So I think that you can, reverse mortgage is great, but I think people take them out a little bit too early. They hit right at the minimum where the fees are the most, the loan to value is the lowest, Now, I think sometimes if they were to wait a little longer, sometimes they get a little better loan when it comes to reverse, but it has benefits and disadvantages just like any other loan. It's a great loan for the people that need it. Um, but that's just the thing. It can be an expensive loan. If you're doing a purchase, what I often show my clients is instead of putting that much down on a reverse mortgage, get a traditional mortgage, take that down payment you're getting and use that to help subsidize or make the payment. So that's a way that you can do it. So I had a client that was buying a $500,000 house. So instead of putting $500,000 down, just paying cash for it, we put like $50,000 down, had $450,000 to make the payment. And that lasted a long time, even with no interest being added to the amount. Then what the clients did is they put that money into an account, they added their social security check to it, and then just drafted out of that account. So the balance was actually going down. They didn't have to pay all the rates and fees. They still had access to the money if they needed to, and they weren't going to outlive their money. So that's one other kind of alternative to reverse, is just the money you're going to put down on the property or what you're doing. So there are some alternatives out there that we work with, but it's a good loan. The reverse mortgage fits just like certain loans fit other people. So, yeah. All right, let's see what else we got. How are we doing on time? Okay. Do lenders check credit after closing a home purchase? No. So after the loan is done, recorded, funded, they do not do another check on your credit report. They can do it leading up to the funding of the loan. So they have a pre-funding audit. They want to make sure you're still employed, make sure you haven't taken out new debt, make sure that nothing's changed, a collection, a charge-off, something showed up on your credit report. So they will do a final pre-funding checklist. But once it's done, funded, recorded, they're not going to pull your credit again. They don't have authorization to pull your credit again. So I don't even know why they would at that point. At that point, it's over, it's done, all that type of stuff. But this sometimes pops up where people think they're pre-approved or they get their approval. They even sign their loan documents and then they go out and buy a car or they go to a furniture store and load up on furniture and appliances or whatever they need. But the loan hasn't funded and recorded yet, and all of a sudden it blows up their deal. So please wait to buy anything major, open up new credit while you're in the process of getting a home loan. Wait till it's totally done, funded, closed, everything's done, because then there's nothing else that happens after that particular point. But I can't tell you how many times I've seen people that pull out some sort of, probably the most common is like a furniture store or appliances or, washer and dryer, maybe a TV for the new place, new entertainment system. They're all excited about moving into this new place. They go up a $5,000, $10,000 card at RC Willie's here in Utah or Boulevard Home Furnishings here in Utah, Ashley Furniture Store, some of these places, but their loan isn't done yet. And why that's a big deal is that's a new debt. That's a new payment. And if your debt ratio is really tight, it becomes a problem. And even if it's not, it just delays it. All of a sudden you don't record. You have to go back to underwriting. You have to re-review everything. Now you don't get your keys on time. Maybe you miss your settlement deadline. Just wait. Wait to buy anything, car, anything with credit, even using your credit. You can use your credit cards. Just don't use them excessively. But anything that's already on your credit, usually fine. But just kind of put everything on hold until the house is done. Just wait till it's totally done. Now, you can a quick caveat for that, or a quick caveat to that. If you need to have your credit checked for utilities, that's a different type of pull. It's a soft pull. You'll be fine. So if you're trying to get home services provided for utilities and stuff like that, you're trying to get those turned on and they require a credit check, you'll be fine there. That's not considered the same thing. That's part of utilities. But anything that's a line of credit, a new mortgage, a new payment, a new car loan, a new debt, installment debt, something like that, you want to wait till the house is done. You want to wait till you're actually in the house. Let's see what else we got here. That's actually a pretty good question. Let's see. Where can I get help to pay my rent or mortgage? Check with charity groups. Check with, that's usually one. Check with your church. Check with, there's lots of organizations that might be able to help you with that. So it just depends on why. You can check with the mortgage company as well. It's interesting here. Where can I get help to pay my rent or mortgage? Those are kind of two different things. You can't really have a mortgage or rent. It's kind of two different things. But anyway, let's see. How much does a lender make in fees when someone buys a mortgage from them? So this is getting into the weeds a little bit, but you have the originating company, the company that originates the loan to begin with. That loan usually gets funded either directly with the lender, so it's brokered. So maybe they follow the guidelines of Provident or Wells Fargo or Chase or whoever the lender is, and they're just kind of that go-between the client and the servicer of the loan. Most loans nowadays get done, funded, closed within the company's name, and then gets pooled with other loans, then sold to a servicer. So that's what they call the secondary market, where they're actually pulling up a bunch of the loans, pulling them into one big pot, and a lender's buying 15 or 20 or 1,000 of them all at once, depending on the brokerage, depending on how they're doing the loan. So the lenders make money on the front end of the loan for putting together the paperwork, the note, the deed, the process, and kind of all the legwork at the beginning of the loan. There's also some money made for once it's set up and established and recorded and the loan's a viable, active loan, not just in the stage of origination. It gets sold to servicing. There usually is a fee for that transfer. It's a lot less than the front end. There's a lot more work done on the front end. The back end is usually margins based on the rate that they're buying, what the rate is available at the day, what type of loan it is. There's a lot of things that happen on that secondary market when the servicing is transferred. Also, I'll keep this in mind. Sometimes the service is just being transferred to a different division within the company, or they have kind of one division that handles the front end, another division that handles payments and escrow and servicing and all that. So there's a lot of things that go on the back end. Sometimes there's no fee at all, no money collected at all when it's transferred. Other times it can be 0.25% of the loan, but then you tie that to 10 or 15 different loans. That's a good amount. But most of the money's really made on the origination, on the front end of the loan, and then the long-term servicing is where money's made for the mortgage company. So that's why there is kind of those two different sets of front end and secondary markets. Let's see what else we got here. I want to buy a home, but my partner has bad credit. Can I still get a mortgage? When you do a home loan and there's more than one borrower on the loan, they will take the middle score of the three credit bureaus, TransUnion, Equifax, and Experian. They'll take the middle score. Then they'll take the lesser of the two. So if you have a husband and wife, you've got the 6 credit scores. They narrow it down to the 2 for each, and whichever's less, that determines your rates and terms, your program, your down payment, your mortgage insurance, all those things. So you can have someone with an 800 credit score and a 600, and they're going to go off the 600 score, whoever's the lower of the borrowers on the file. So what you try to do is either not have the partner on the loan, in this case, partner, spouse, especially if the spouse is not bringing any income to the table or assets or anything. What I would recommend in that case is just do the loan in the person's name with the better credit, income, and assets. You can always add the spouse or the partner to the title report, so that way for estate planning or if something happens to you, they still get the home, but they don't have to be on the loan to be on the home. So they don't have to be on the mortgage to actually own the property. So that's one way you can protect for any estate planning or something like that. I really recommend doing a trust. Once you have the property, really do a trust so you can itemize what happens with the property, avoid probate, avoid all those things. I really recommend doing a trust. But the short answer to this question is yes, you can still buy a home with the partner being on the loan. It just will affect the rates and terms, or try to do the loan without them. Now, what usually happens in these situations, though, you need both incomes because credit cards and car loans and stuff are in both names. So if you take off one borrower, you also lose that income. So the next tip I would give is work on the credit. They got bad credit for a reason. If it's a budgeting issue, start working on those types of things. If it's just past medical issues, if it's past collections, if it's just most of the time it's going to be a mismanaged budget or an emergency when it comes to medical. Just got to start grinding through it. You got to start paying what you can. You got to start cutting corners where you can. You got to stop eating out. You got to start budgeting a little bit better. It's worth it. But most people take at least 90 days to start changing the way they do their finances, and usually it can take a year of building up the credit where you can qualify for a home loan. But it's far better to work on the credit than just take whatever loan you can get, because the rates and terms are going to be worse. And there's so many little things you can do to boost your credit, even to that next tier where you get better loans, better rates and terms. So that's where I would start. Find out why is the credit bad, what you can do to fix it, and really put together a game plan and stick with it. You'll get there eventually if you start today. We're right at the 20-minute mark. Let's see. Let's do a couple more here. Is it possible to reduce a home loan without prepaying? No. Is it cheaper to pay off a mortgage early or just keep paying? Is it cheaper to pay off your mortgage early or just keep paying monthly payments? We've kind of hit on this a little bit, but again, pay off the other debts. $100 on a mortgage is great. Putting an extra $100 on a mortgage is great, but an extra $100 on your car or $50 to savings, emergency funds, or increasing your retirement accounts, that can go further than $100 on the mortgage. So for me, I look at their whole situation and say, okay, where is the best use of this extra money? If we're going to consolidate and get rid of a bunch of debts, where's the best place to put the money that gets rid of debt quicker, frees up cash flow quicker? Now, people will look at their credit cards and say, I'm going to pay off the highest interest rate first. That is great. I really think, what is the lower balance? What frees up monthly expenses faster to that debt can then be rolled into the next debt. So you can build up some momentum. I mean, budgeting in this is a lot less about math as it is about building momentum, staying motivated, being able to see stuff getting paid off, having less credit cards, tearing some of those suckers up, and being able to then redirect a bigger amount to the mortgage. But I really feel the mortgage is one of the last things you should pay off because it's a fixed rate, locked in payment that nothing else is locked in like a mortgage. Utilities aren't going to be, taxes aren't going to be, your income isn't going to be, but a mortgage payment is locked in. So it's something where that is a stable debt. It's a stable debt, and it's usually cheaper for the amount borrowed than almost anything else. So if you have any other debts, I would start tackling those first. So then if you have, say, $1,000 worth of car loans, payments, like $1,000 worth of payments on car loans, visas, whatever else, if all of a sudden that $1,000 can go to a mortgage, now you're really going to start accelerating. But I still think you want your savings first. You want reserves first. You want your retirement starting to go because those can go faster. So you're still paying down your mortgage while building your savings. So then you have a huge lump sum that you can just pay off and get rid of the whole thing. So that's part of my job, is to look at the overall situation, give the best tips and advice that I can that will help people stay on track. And I think paying off the mortgage should be something on your horizon, but it shouldn't be the first thing you're looking at, because the same amount of money you're putting extra to a mortgage can go way further on the other debts. All right, let's do one more. If you're in default on your mortgage, can the lender sell the property? No, you can still sell it. So even if you're in default and missing payments and you have your notices, they can't sell the property. Now, if they're in the stage of foreclosure, they eventually can. So eventually, yes, they'll be able to sell the property and pay off the loan balance. But if you're early on in that stage, so I guess the answer is it depends on what stage of default you're in. But if you're just got your notice of default, there's usually requirements of waiting periods. There's 90 days to give you notice, to try to catch up the payment, work out with the lender, sell the property, do something like that. Once you pass that stage, if it goes to the courtyard steps, that's where you lose your ownership. That's where they own the property. That's when they can sell the property. But just because you miss a first payment, let's say you're 30 days late, you get a notice, that doesn't mean the lender is selling it right then. There's waiting periods before it gets to that stage, but that stage is coming. So you want to start either working with the lender, get the property sold, do something to try to get the situation resolved. Because if you just keep waiting and put your head in the sand, eventually the lender's going to get the home. That's what they're foreclosing on. That's the collateral of the loan you borrowed, is the home. That's what they're going to take back to get their money back. All right, that was a quick one. Let's do one more. I hope you guys like these videos. I got a bunch of them. I've got a how-to series. I've got other videos that are on there. So I hope you enjoyed the videos, but I'd love to have any comments, feedback. Let me know what we're doing right, what we're doing wrong, all that fun stuff. All right, let's see. Where can I buy a house for $100,000 in the U.S.? Detroit? That's probably a bad joke, but there's $100,000 homes throughout the whole country. It's just whether or not you want to live there, what the quality of life's going to be. I'm sure there's a property in middle of Dakota that probably is that much, or I don't want to pick on bad, not really bad places, but there's places where $100,000 is going to get you a house. Now, is it going to be on the beach in Hawaii? No. Is it going to be downtown Los Angeles? No. But there's places where you can buy a house for $100,000. They still exist. Let's see. Should the principal amount on a home loan be included in the income and expenditure statement? Should the principal amount of the home loan be included in the income? No. So the balance of the loan, if I'm reading this correct, and like debt ratio, those types of things, the balance on the loan shouldn't be, it's that monthly expenditure. It's the cash flow. It's what does it take to maintain the debts. That's really what you're putting on an income statement. Let's see. If you inherit a house that still has a mortgage, do you have to pay it off, or can you keep the house? Yes. The home is the collateral for the loan. So even if you inherit the house, the lender still wants their money back. I can't imagine why, flip that around. If you loan money on a house and the person died, would the loan just disappear? No, the house is the collateral for the loan. If you inherit the house, you have to sell and pay off that loan, or you have to do a refinance to free that lien off the property. Now, some lenders will work with you on the time frame as long as payments are made, but if all of a sudden you stop making the payments on that, the collateral is the house. They're going to come and take the house. That's eventually. They'll give notices. You have time to reinstate loans, pay it off. But if the mortgage company doesn't get their payments, they're going to start the process of foreclosing. So just because you inherit a house doesn't mean it's free and clear. Doesn't mean just the lender's out of luck and they just have to go find their money somewhere else. The house is collateral. They will take that property back. 25 minutes or so, give or take. Let's do a couple more. I just like doing it. This is fun. I don't know. I haven't pre-screened these. I just jump in here and just see if I can answer the questions. So sometimes I misread. After I watch the video again, I'll reread the question and go, ooh, I missed that question, but it was a great answer. Let's see. What happens to a veteran's home loan when they divorce? This is the one difference with the VA loan is if a veteran gets into a divorce situation and let's say the wife that's not a veteran is assigned the home, they can still go get another VA loan. So in a divorce situation, unless they're not on the loan and on the title, there's some caveat with that depending on the situation. But generally speaking, whoever's awarded that home can keep that loan, and then the veteran can go get another VA loan and buy another house. Usually what happens in divorce situations as well, though, there's some sort of refinance, either remove a borrower off the loan or cash out equity or just sell the house and have a fresh, clean break and everybody goes their separate ways. But what happens to a veteran's home loan when they divorce, as long as they're still on the loan on title, they can keep moving forward with that loan and the veteran can go buy another house. So you can, that's the one exception with VA. VA only allows one loan out at a time. So you can't have multiple VA loans unless there is a divorce situation. That's one of the times where you can get another veteran loan if you qualify. Let's see. Let's do one more. Boy, there's some good ones on here today. What is the definition of gross rent? Does it include mortgage interest for FHA loans? Ooh, that's specific. So what's the definition of gross rent? Gross rent is what you receive from the rent agreement. So if your lease agreement is $2,000, or you're renting a property at $2,000, you get $2,000, or you get $2,000. The net is what you make off the tax returns, or most lenders are going to take 25% expense ratio off the top. So they'll have a net rent calculation that they will use. Now, they'll use your tax return. So if you write everything off and you claim a zero amount, then it just gets rid of the mortgage payment, and depending on how the tax returns are done. But generally speaking, they'll take a 75% of the gross rent and use that as part of your potential income. It depends on how long you've owned the rental home. There's a lot of guidelines when it comes to rental income. But does it include mortgage interest for an FHA loan? No, because gross rent and mortgage is different. Those are two different things. You got the rent you're receiving on the home. The mortgage interest is what you're paying to debt service the property. So let's say, this may not be where the question's coming from, but let's say that you have your current home right now, you have an FHA loan on the property, and you want to go buy another house, but you can't qualify for your current house and the new house, but you're going to rent your current house. You're going to rent your FHA home. You're going to go buy another property. You can use the rent that you're receiving, but they don't use 100%. They will take that expense ratio out. Now, they'll either want a history of being a landlord, depending on the loan program, on the new house you're buying, but they'll have some sort of calculation where you can at least use some of the rent you're receiving on the exit property to be able to qualify for your next property. It's usually 75%. So easy number, if you're renting it for $1,000, they'll give you $750 towards your income. But if your mortgage payment on that house is $900, you're still negative. You're still covering some of that mortgage payment in your debt ratio. So that's why cash flow is huge. That's why being able to rent it for more would help. And that's why having some reserve left over, and when you get your rents, make sure you kind of keep back some of that money to cover a mortgage payment because you're still on the hook for that loan. But I think that's probably where this question is coming from, is how do you calculate the gross rent versus net rent? And can you buy another house and buy another FHA loan, that type of thing? Okay. I'm just having too much. We're going to do one more. Why not? Why not? Let's see how many people made it this far in the video. You know, you never know. One more. Let's see. Do people with a mortgage on their house still travel? Well, yeah. Do people with a mortgage on their house still travel? I do. I've got a lot of mortgages. I got a bunch of properties. So, yeah. Yes. You can be a homeowner and still travel. I love these questions. Sometimes they're fun. All right. Oh, we're hitting the 30-minute mark. I usually try to keep these to 20. I just got onto a couple tangents, and there's some great questions today. Okay. Will your bank give you a loan if you're late on your mortgage payment? Depends on what you define by late. Some people are past the grace period, and that's technically late. But if you get 30 days late, 60 days late, 90 days late, start getting into these late past 30 days, that's where your credit score starts to take a hit, and you start limiting which lenders will do a new loan for you. But there are some that will allow what's called a 30-day late, or even a couple rolling 30-day lates, as long as there's a reason, explanation, and as long as it doesn't totally trash your credit score. So will a bank give a loan if you have a late? Yes. If it's more than 30 days, you limit your options. 60 days, limits more. 90 days, you're killing it. I mean, the more late it is, the less likely you're going to get good rates and terms, and the lower amount of lenders. But there's lenders that'll loan you if you're 120 days late, but they won't loan a high percentage as far as loan to value. You may have to put a bunch of money down. Your rates and terms aren't going to be as good, but there's lenders that'll loan to just about anything, even on a mortgage. But it depends on what you define as late, whether you're 30 days or just past the grace period, how long ago the late was, and it's going to affect your rates and terms, and especially your credit report. So I hope you found this information useful. I'd love to help you with a home loan. I do loans here in Southern Utah. That's where I'm based out of. I do loans throughout the whole state of Utah and Nevada. I love an opportunity to get you pre-approved. You can check out my website. It's down below here at ryanbolton.com. I've got a great mobile app where you can apply right there. We got a great line of credit if you're looking for a line of credit on your home. Great different options to help you buy or refinance a home. Call me anytime. Check out my website, and hope you enjoyed the video. See you next time.